Okay, so just to start off from the point where we left it off yesterday. So you would see that the last class we started discussing about different. We were talking the different kinds of business products, right? So we have completed our discussion on credit card as a business product, the different sources of risks associated with credit cards. After that, we started talking about another revolving product called the overdraft. And from the overdraft onwards, the next part that we started talking about from there was that of personal loans. So one thing that we got to see over there is that for revolving products, be it credit cards or be it the overdrafts. We saw that from there, the next part when we moved on to personal loans, we saw that the major difference between the two products lied in the fact that the revolving products were an open-ended product, whereas these term loans, like the personal loan, etc. So they are your fixed end product, right? So having said that, the next part that we go into discussion is the personal loans, and our objective was to talk about the different sources of the personal loans, different sources of riskiness which can arise for personal loans in specific, right? So basically, one part over here is that there is a high amount. So basically, we saw that personal loans as a product are closed-end products. That is, they have a fixed term of maturity, right? And every month you are required to pay out a certain amount of an EMI. There is equated monthly installment, and within that EMI, there are two components. One is the principal, and the other is the interest. When I talk about the principal, what I essentially mean is the amount of loan that I have actually taken, right? And the interest is the opportunity cost of me holding the money from the bank. Now, the total EMI is comprised of principal plus interest, and the entire loan amount is amortized across the different installments, such that in the initial set of installments, the contribution of the composition of principal towards EMI is lower, whereas the size of interest component is much larger, and as your EMIs progress, what you see is that the component of the principal component in the EMI increases and the interest component reduces, right? And and that is how this entire loan process is mitigated. Therefore, the way we were thinking about riskiness from the perspective of revolving products such as overdrafts or credit cards is not the same. The same, so the riskiness would be a little different for that of personal loans. Now, one thing over there is that for personal loans, one thing that we need to understand: the personal loan is also is a kind of unsecured loan, right? And it's a loan which is typically given for maturity between 3 to 5 years. Mostly, is in the Indian market we get to see loans of 3 years or 5 years. And over there, we were talking about different kind of what are the different kind of variables which become important in explaining the riskiness associated with personal loans. And some of the important variables which we saw were high amount, high duration, amount of the loan, the duration of the loan, the EMI to the disposable income, and so on. So we started talking about we tried discussing the different kind of riskiness associated with the loans at origination. So how is it that a particular so if there are two borrowers A and B, then how would the bank distinguish between who is the more risky borrower and who is a relatively less risky borrower? So what are the parameters of doing that? And in respect of that, what I have is this balance. So over there, we saw that there are different matrices across which the bank analyzes. The so one very important difference between personal loan products or these other other retail portfolio and the QRRE portfolio is that for this revolving products, there is always the riskiness always arises from a drawn amount versus an undrawn amount. On the other hand, for personal loans, this kind of a thing does not really happen. Therefore, because the personal loans do not have any such as undrawn amount or drawn amount, so it is purely a loan that has been given and deducted in EMIs. So the sources of risk for personal loans are relatively straightforward. So we started exploring. We had also explored what were the sources of riskiness. The main sources of riskiness that we could see over here are first is the QRR. So basically, for personal loans at acquisition, the checking account status of a borrower or the current account status of the borrower is really very important. So the idea over here is that if there is a borrower who is applying for a personal loan and this person already has a current account in his name, so he already has an overdraft kind of a product with him, then especially a overdraft product, not a credit card, but especially an overdraft. That's a current account, which is also in some regions it is also known as the checking account. So if a borrower has a current account and there is a current account history to this guy, then automatically for the bank, this guy becomes the guy with a current account history becomes relatively more risky compared to a guy who does not have a current account, right? So the idea over here is very simple that the bank thinks that this guy takes up a loan of say 5 lakhs. Now he pays up to 1 lakh. Now what happens is there is a stress situation which arises in his life and he already has a current account whose limit is 6 lakhs. So what this guy will do is or what this guy can do is he can actually draw the money from the current account, close up the loan, and then he defaults on the current account. So then the overall, so this is how the overall riskiness of a borrower with a current account is higher compared to that in the that without the current account, right? So on the other hand, so if a guy now has, so that is the reason why a guy with a current account is considered to be relatively more risky than a guy without any current account history, right? So after this, the next thing that comes out is that out of the people who all or out of all those people who have a current account with the bank, right? So out of them, how are the relative riskiness of the borrowers decided? So then the current account history of the borrower is checked, and if it is seen that the borrower has a positive current account balance, that is, he has not overdrawn his current account and has a good positive current account balance, then what we see is that that borrower is a relatively less risk borrower compared to those who have a negative current account balance. That is, there are guys. So suppose if there is a guy who had a current account, who had a overdraft and had an overdrawn current account balance, then just before giving him a loan, it would strike to the bank that okay, man, this guy already maintains a negative current account balance, and hence, if I give him this thing, my hypothesis is that this guy might default, go first try to default on loan, and then prevent it by overdrawing from his current account, and he goes and finally defaults. So he defaults on the overdraft rather than on the personal loan. Therefore, these guys are the most risky guys in my portfolio. So bank would obviously think twice before giving the loan to a guy who already has a current account and maintains a negative or an overdrawn current account. Also, if on the current account, if this guy is, you know, if he has been delinquent and if he has a delinquent history with this bank, that the bank would be all the more apprehensive to give him a loan. So therefore, the existence of a current account or some kind of a checking account for the customer becomes really very difficult for him to handle. Right. So if he has a current account with the bank, and then he tries to, apply for a loan, and he has an overdrawn current account, in that case, it becomes very difficult for that person to get a loan. Also, even if he gets a loan, he might get it at a higher price, and he might get a relatively lower amount of loan than he has applied for. So that is again one very important. So this is one very important segmentation structure which is available for personal loans, right? Now the next part that we have over here is the high amount. So basically, the next part that we talk about is the important variables that are there. So we saw that the amount of the loan, the duration of the loan, the EMI, to the related disposable income, and other variables like age, etc. They tend to explain the riskiness of the borrowers, right? So these are important variables because loans which have been given for a higher amount or for a higher duration, for a higher duration, are considered to be relatively more risky because number one, for a higher amount of loan, given everything remaining unchanged, a loan of a higher amount is a greater exposure for the bank. Also, on the other hand, given everything else remaining unchanged, given the duration, a loan of a higher duration exposes the bank to a given exposure for a longer period of time, and in that longer period, there is a greater chance of the bank of the borrower's financial statements to adjust. Hence, this is a challenge for the banks, right? So that is the reason why loan, higher the amount of loan or higher the duration for which the loan has been taken, are considered to be relatively more risky propositions for the bank. Right now, another very important part of of assessing the riskiness at acquisition is the disposable income of the borrower. Right. So, what is the amount of income that this guy takes, the borrower takes back home? Now, yes, in the last class we had discussed about concepts like fixed obligation to income ratio or debt burden ratio, or the debt income ratio, and so on. So these are very critical variables for assessing the relative riskiness of the borrower. So having said that, the so uh, so basically, before moving on, let me just highlight the concept of fixed obligation to income ratio. Now, having a higher income does not necessarily mean that a borrower is a safe borrower. A borrower might be equally risky, even if he is, if even if he is a, a borrower who has so even if he has high income. So what matters is how much of the disposable income is available for the guy to pay the EMI of this particular credit that he's asking for. So having just 1 lakh earning 1 lakh rupee a month does not necessarily mean that this guy has a very, you know, this guy has a very high capability to take the loan. It might be the fact that he is already paying out EMIs worth 40,000, and the remaining 35 to 40,000 goes into his living and all, and then there is 20,000 which is left, and the EMI that he may be required to pay for the loan is around 20,000 per month. Then, in that case, the guy does not have sufficient freely disposable income or free income to pay up that loan, right? So, therefore, it is very important to assess the fixed obligation to income ratio. So over here, the next, therefore, this metric of FOIR, or fixed obligation to income ratio, is a very important factor in taking the decision of whether a borrower is a good borrower or whether a borrower is a bad borrower. So this is what the fixed obligation to income ratio is. Turn to income ratio. and this is what we call the FOIR. So this FOIR or 1 minus the FOIR is, or that gives the freely disposable income, the free disposable income required for, or which is required by the, which is which the borrower has to pay back this current loan. Now, these are mostly these cases that we have discussed over here are all acquisition cases, right? So when I'm trying to assess the borrower, whether the borrower has the affordability to pay the loan, or he has, or whether he has or has not the capability to pay the loan, or so this guy, can this guy be given the loan or not? So that is the decision that I am trying to take over here, and by looking into all these variables. Now, another very important aspect of acquisition of a borrower at, you know at origination is that his state of savings account. So, how much of balance, or what is the average savings balance that a borrower has in the savings account? Now, the average savings balance of a borrower, or the average, the value of the term deposit that a bank, or demand deposit that a borrower has with a bank, gives the idea about his financial security. So, for example, suppose I know that you have a given income, right? And your fixed obligation to income ratio is relatively higher, the higher side. But at the same time, you also have a very large savings balance. So that savings balance, or the average savings account balance that you generally maintain, is an indicator of how much or how secured you are as a borrower, right? So this is something which again needs to be taken care of. So basically, when I talk about the so basically having how much of money a particular borrower has in the savings account will drive his security as a borrower. So larger the balance, the savings balance, the average savings balance maintained by the borrower on a month-on-month basis, the more sound he is considered to be as a borrower. Now the idea is that even if this guy loses his job, the amount of savings balance this guy has, this guy can actually pay back my credits even if he loses his job, or even if a stress situation arises. So he already has a buffer income which he has saved up with the banks in form of demand deposits. So which need not always be savings account balance, but it can be any kind of demand deposits in terms of FDs, recurring deposits, etc., etc, right? So that is another important variable. So one another important variable, as we discussed, is the average savings account balance that a borrower tends to have. So the higher the average savings account balance, the greater are the chances of the borrower of being a good borrower. Savings balance. So average savings balance. So average savings balance as a variable is again very important. But it is not just the average savings balance that I maintain at one point of time. But for this variable, I need to have or look out on a month on month basis. How is it that this average savings balance is evolving? So that is again something which is really very important, right? So apart from this, so these variables that we have discussed over here, be it the checking account status, be it the savings account status, uh, a high amount, the amount of the loan, the duration of the loan, etc. So these are your so if you look into these variables broadly, you will identify that the average savings balance and the average checking account balance or the state of the current account, these are some financial information of the borrower, some information of the financial behavior of the borrower. If you look into the amount of the loan, the duration of the loan, these are some loan specific information. So at acquisition, you either look into the into some variables which give you an idea about the historical financial behavior of the borrower, or you look up into some factors where you have some you look up into those factors which contains the information on the product or which contains the product information. And the third kind of variable that we look at origination is the kind of demographic variables. And when I talk about demographic variables include not only the place where this guy stays, but it comprises of a lot of different kind of other variables as well. Now, one very important factor within the demographic factors is the the real estate or the property ownership of this borrower. Say, for example, there is a borrower who has his own house. So you know that this guy is in a position that he would not be, he would not be uh, so this guy has his own property, so therefore he has a decent amount of wealth, and his chances of defaulting would be relatively lower if I give him the loan. So it is not that if I own a house I would always be a good borrower. It is just that if I have my own house, right, then it means that I do have some substantial amount of wealth, and I can manage a personal loan. If I can afford to make a EMI payout for a home loan, I can also manage a personal loan. And to attest to that, the savings account balance, the average savings account balance, the current account status, if any, is looked into, the FOIR is looked into, and so on. But again, the very fact, say for example, there is a guy who does not have any real estate of his own. He does not own any property. He just stays in a rented house. So his credibility from the point of view of getting the loan is relatively lower than a guy who would have his own residentials. So these are some basic demographic variables. Now, apart from this, there are again other variables, right? Now, another very significant variable which we have gradually seen is the gender variable, the gender of the borrower, and it is generally seen that female borrowers tend to be relatively less risky than male borrowers. But gender is such a controversial variable that we cannot use, we cannot always use it as a scorecard variable, because there are many countries where which do not allow you to discriminate between lending policies based on the gender of the borrower. So from here we can see that at acquisition, the variables which explain the relative riskiness of an applicant or of a potential borrower can be broadly divided into three parts. One is the historical behavior of the borrower, historical financial behavior of the borrower, which is captured through the current account and the savings account status. The second type of variable that we have over here is based on the second type of variable that we have over here is based on the information or the financial information or the loan information in terms of the amount, duration, etc. The third set of variable that we have is on the demographic variables. Therefore, these three are the broader or these three are the three broad groups of variables under which but through which we can actually explain the chances of a borrower of being a good or a bad borrower. So this is what happens at the stage of origination. And using these most significant variables, the application score is generated, very similar to what was done in the credit card side of things. And based on that score, it is decided whether a loan should be given to a particular borrower or not, and second, whether or also, even if he is given the loan, what is the amount of credit which is to be extended out to this particular borrower, right? So this is what happens more or less at the origination of personal loans. Now, having said that, let us think about some of the application, some of the strategies, or some of the application strategies which a bank can decide basis this application score, right? So basically, what the bank can actually do is the bank can try to think about different ways of managing the credit at the application stage, uh, by using application score as an input. Not only application score, but also others. But also there are other variables. But out of that, we are just talking about application score. We are trying to assess the role played by an application score in taking these basic business decisions. So let us think about it over here like this. So, for taking the decision, every bank will have a cutoff application score. So, if the borrower gets a score which is greater than the cutoff application score, then the borrower is generally given the credit, right? Now, however, again, if the borrower is given the credit, we need to frame some sort of an idea about how much of credit should be given to this particular borrower. So over here, say, so therefore I can we can say that at origination there are two types of strategies which the bank again needs to frame. So, or origination strategies can be broadly of two types. One set of strategies involves the accept decline strategies, and the second is the loan assignment strategies. So origination strategies are of two types. These two broad types we have also explored while we were discussing the credit cards as well. So one is accept, the second is decline, and the third and the second that we have over here is the strategy. So it's the loan assignment strategy. So how much of loan is actually assigned to or should be given to a particular borrower. So over here now the accept decline strategy is pretty simple, right? When we can understand that uh, if your score is above a cut-off score, you just give the borrower a credit. I mean, you accept the borrower, else you reject the borrower, and so on, right? But again, accept decline strategies. So within decline again over here. So when I talk about decline, decline is of two types. One is a score decline, the other is a policy decline. One is a score decline, the other is a policy decline. Right. So basically, as we know that a score decline actually occurs when a particular borrower does not satisfy the cutoff scores and hence he is just declined. However, there are others such as the policy decline. Now, under the policy decline, what happens is you are actually not, you may have your cutoff scores, but you do not satisfy certain policy requirements, and hence you are not uh, given the opportunity of getting the product. So over here, so mainly application scorecard can take care of the score decline. Right now, apart from that, there are other policies which come in, and which becomes very important from the point of view that I may not be satisfying certain policies. Say, for example, there might be uh, some policies which is totally available for the staff of the bank, and I may be an outsider, so a non-staff guy, so I do not really apply for. I mean, I'm not eligible for that. So basically, if I am a guy who is, if I go and apply for that, then I would not be given that product because that product would be solely available for the staff. Hence, that is a case of policy decline. Or it might be that, yeah, there are certain sanction areas or certain red listed areas, red flagged areas, from where if I apply, I would be directly system rejected. Right? Not even I would not be applied for the score side. So, for example, I'm a very rich chemical manufacturer in uh, based out of Syria. Now, I would not be getting that loan because Syria, for obvious reasons, is a flag, which is a sanction. It forms a part of the sanction list of the nations, and hence it is not possible for us. It would not be possible for me to get the loan out of there. So this is the way this entire thing happens, right? So at origination, the application scorecard is used to take up an accept decline decision. But the second decision is also equally important, where you are using it to assign the credit for a borrower. So what you are trying to do is you are trying to understand that what is the amount of credit that I should give this guy. So, for example, if the guy has a credit score, already he has a credit score, you look into the credit score. So, lower the credit score, lower will be the limit that is given to him, right? And higher his credit score, higher would be the limit. Now, again, when banks give, some banks often do a calculation. So, they compute, your eligibility of a loan. So, basically, say your salary is your monthly salary is sum is zero. So your loan eligibility for the bank is a constant k, some k times your salary, your monthly take home salary, minus your other loan commitments, or which you do in terms of EMIs. So EMIs, as in if you have any other personal loan with that bank or with some other bank. Second is credit card limit. So basically, what you have is a credit card with that bank. So then that credit card limit is also adjusted, right? And after doing this adjustment, what you get is your loan amount. So I am just showing you a representative kind of a loan assignment. So I'm just showing you a loan amount, a representative loan amount kind of a thing. Okay. So over here, what we have is K star is not minus EMI minus credit card limit equals to the loan amount, right? So your loan amount is, so you have to determine this K and these factors which needs to be removed, and how much of them is to impact your affordability, or I mean your capability of getting the loan. So this is one possible way in which the calculations are done, and all these variables like K, the EMI, the credit card limit, or which are the loan that needs to enter into this for subtraction, they need to be determined, and these set of models, they form a part of your strategy model. So at acquisition, what you try to assess is and how much of the borrower or how much of the loan should be given to the borrower, right? Like also, the role of these strategies, the role of application scorecard as a means to strategize this loan at origination can also be used, in case when you are trying to combat different downturns or recessions. Now, by increasing the application score sufficiently higher, you can actually you can actually make your portfolio relatively less risky because you are giving the loan to the best possible customers at that point of time. On the other hand, so basically it might be the case that, say, when a model was created, right, the model was created with this three segments: the borrowers with checking account, borrowers with no checking account. So over there, the borrowers with checking account had was considered to be a relatively high risk segment, and the borrowers without checking account was considered to be relatively low risk segment. On the other hand, within this, there were two other sub-segments like balance greater than zero and balance less than zero. Now, with balance greater than zero, it was considered to be a low risk segment. With balance less than zero, it was considered to be an overdrawn or a relatively high risk segment within the high risk segment. So, within the high risk segment, the higher risk segment was those accounts whose balance was negative due to an overdrawn current account. But looking into other factors, they were given the loan. And say this was done during a formidable, during a baseline period or during a time period when there was growth and everything was okay. Now what happened is that the economy reaches a downturn, right? So the economy enters a downturn phase where the portfolio start becoming more and more risky. Now when this happens, what the management decides is that we are just going to give the loan to those guys who have who do not have any current account, right? So right away, the this part of the segment is written off. So the bank goes very conservative. They take up a conservative lending policy and they tell you that, man, I am not going to give you the credit if you are going to have a current account, or if you already have a current account where you are actually borrowing. So I would only give the thing to this people. I would only give this thing to people who do not have a current account. So they are the safest guys. They do not have any additional sources of delinquency, and I'll just give the loan to them. So the moment this happens, the overall size of your portfolio totally changes. That is, you are ramping down one whole segment of your portfolio. And the moment this happens, your entire model changes. So that is where, so this is how, you know you can actually combat your recession, your downturn policies. And you may say that, okay, man, I'm not going to give a loan to this guy, to these checking account guys. I only give to those who do not have a current account with them, who only are applying for the personal loan. They have a decent income, and I raise their bars on the income requirement and stuff of the debt burden ratio and all, and I hire only the best quality of the borrower because I know that since the downturn period there would be high chances of job losses and etc. And if I choose those people who have the best possible characteristics, I mean, who have the best possible financials, they would have lowest chances of defaulting. And hence what happens is the entire segmentation structure of my model changes. So basically, I might be booking very less customer or no customer under checking account, and I would be booking almost all my booking would come from the non-checking account. And having done this, I am totally altering the nature of my portfolio. That is why you would see that for bookings which are generally done during downturns tend to be relatively less risky than those bookings which are done during growth periods, because during downturn period the bank is always assigning a higher weightage to the extent of conservatism to the to the conservatism aspect than the growth aspect. And during the growth times, during normal times, the bank just does the reverse. Hence the bank allows for some risky borrowers to come in, and they are willing to, their risk appetite is generally higher. But during downturn period, the bank's risk appetite is relatively lower and only the best possible bookings are taken. Hence, the quality of bookings done during downturn is relatively more, I mean, relatively less risky. It's very less, the overall risk is very low compared to the bookings that are done during normal or baseline periods, right? And all this can be done, all these differences in the acquisition strategies can be brought about by using application score, right? So I'll just take a pause over here and I'll take up any questions if you have.
No, I do not have any questions. I think I've understood what you were trying to say regarding the factors, the accepted client policies and the loan assignments, and also regarding the economic phase downs, down that at the time of downtowns, the banks becomes more conservative,
Correct.
and so they choose the best possible borrowers that do not have a current account. And during
So let's not
the
be
growth
that specific,
aspects.
right? So let's not be that specific. It was an example which I gave. So if you are actually telling
Okay.
someone, say as in an interview, your idea would be to tell them
Mhm.
that during downturns the bank,
For example.
yeah, so the bank tends to book
Okay.
up relatively less risky borrowers because the bank is
Okay.
giving a greater weightage to conservatism rather than to the growth during downturns. And just the reverse
Okay.
happens for the portfolios when the bank is trying to grow during growth periods or normal time periods.
Okay. So the factors must be dependent on the banks, that how the bank is and how the policies might
Yes,
work. So
obviously,
according to that,
obviously,
they take
obviously.
steps.
What is the
Mm-hmm.
strategy or what is the the management's outlook for that bank? How are they
Mm-hmm.
driving the bank? That will determine how they would deal with these parts. But generally, during
Okay.
downturn, all banks become conservative because they
Yes.
have to send all
Mm-hmm.
the regulatory reports and all, given the external transparency that on which it is being stressed now. Therefore, they are
Mm-hmm.
the banks are actually very conservative during downturns, and which causes them to you know like so it is that conservatism which is reflected in their policy. So during downturns, we see banks, all banks on the whole, becoming more or less stringent. But during down growth periods, or say during normal economic situations, that is where the vision of the bank comes into play.
Okay.
Right? Great. So
Right.
moving on.
Mm-hmm.
So moving on to the next part. So there are, apart from this, there are other ways through which a bank can control credit during as recession control periods. Now, one is increasing the time gap between the two loan top ups. So, what is a loan top up? A loan top up is I have taken a personal loan. After a point of time, so say I've been paying the loan for say some 12 months, 18 months, something like that now. And it has been 2 years I have been paying this loan on a month on month basis. So, what happens is I generally have given behavior, right? So, and after a point of time I might demand a loan top up. So that is a secondary line of credit which comes up for me in the form of a top up. Now when this top up happens, now generally during normal times the banks are very impressed, the banks are always happy to give you a lot of these loan top ups, they ask you for credits and all. But during downturns, bank becomes very conservative again. And what happens is they set out a minimum amount of time between two top ups. That say today, so the minimum gap between two top ups is 6 months or more. On the other hand, during good periods, what they would always tell is they would request you to take up loan top up within a gap of 2 to 3 months or something like that. But during downturn periods they are very specific that man, if you have to take a top up, you can take it only after it has been say around what should I say, it has been around uh, like 2 years, or I mean, it has only been around 6 months or more. So by giving that, creating that gap, the bank tends to control the amount of credit, the amount of exposure which goes out to the borrowers. Because and even when they go out, they are given to the best possible borrowers. So using these scores, be it the application score, be it the behavior score, the amount of credit, or the quality and the quantity of credit can be controlled by the bank. So they prove to be very good credit control mechanisms as well. So now for loan top ups, and also similar like behaviors, like credit cards, we have seen that there people come up, credit limit increases, credit limit decreases. Now these secondary lines of credit are based on, not on the acquisition of the borrower, but on the behavior that the borrower exhibits once he or she has been taken on the books of the bank. So once I have been taken on the books of the bank, I keep on making my EMI payments, and the bank analyzes my payment patterns, and they generate a behavior score for me. So when they are generating the behavior score for me, their objective is to understand that how much of that that how good or how bad I have been as a borrower. So how high is my willingness to pay back my credit to the bank. So I have taken a credit from the bank. Now, how much am I willing to pay back this credit to the bank? So this is what I need to understand. So this is what the next stage comes in. So over here, in the last discussion, when we were discussing the behavior stage and the behavior scorecards, etc., so we had done an overview discussion of behavior scorecards, right? Now, what we need to understand today is, or while talking about personal loans, what we will talk about is that how would the variables for the behavior scorecard differ from a person for a personal loan compared to that of a credit card. So in a credit card, what are the different type of variables that were there? In over here, we look to that what are the different types of variables for the personal loan. And when we do that, we will be comparing between the two types of, you know, the two types, the difference in the nature of the variables between the two types of the loan, right? So let's see what are the variables. Now, if you think about the credit card, so what were we trying to do over there? So, at a very broad level, we were trying to assess the willingness of the borrower to pay the loan. So, how willing is the borrower to pay his credits? So, if we what we saw was if his utilization was very high and his payment balance ratio was relatively lower, and we saw that his utilization kept on increasing on time to time, but his payment balance ratio was not there. I mean, it was not as high as it. Therefore, the gap between the two was called the difference. I mean, that was the gap between the two. Now, this gap between the two created this. Uh, if the gap was gradually increasing, we could say that his willingness to pay back the loan was not as high as his willingness to consume, and hence he had a relatively lower willingness to pay back than some other people. So that would determine his behavior scorecard. The lower the willingness of the borrower to pay back the credit, the better are the chances and higher are the chances of the borrower to default. So having said that, the next thing that we would try to do over here is that we would try to understand how this how or what type of variables can be used for behavior scorecards of personal loans. So what are the variables which gives me an idea about the willingness of the borrower to pay back a loan? Now, like unlike a credit card, right? I do not have any concept of utilization or payment balance ratio or stuffs like that. So what I need to do over there is I would require to understand that how is it that, so basically over here the EMIs are fixed, right? So what is it that will help me understand the willingness? pay of the borrower, or how would I know that the borrower is willing to pay back the loan or not? So obviously, one very important variable over here, the most basic variable that we can think about, and that variable which is common across all kind of behavior models, is the delinquency variable. So by looking into the delinquency variable, we can try and understand that how likely is the borrower to pay back his credit. So delinquency patterns are really very important predictors at a behavior stage. So this is what is delinquency. And delinquency variable also is one of the most important segmentation variable at a behavior stage. So based on the delinquency behavior of a set of borrowers, you can actually divide the, you can decide that who is a less risky borrower, who is a more risky borrower, and who is an unpredictable borrower, who is an unpredicted borrower. So that is something that we can actually do it, or who is an indeterminate kind of a borrower. Now, over here, generally for credit cards, we have, based on delinquency, or based on this payment, based on their payment patterns, we could divide them into three parts. One is the set of active borrowers. So active borrowers are those borrowers who are on the books of the bank and has been non-delinquent. The second is the set of delinquent borrowers themselves. So borrowers who are still on the books of the bank but has gone delinquent. And the third was the group of inactive borrowers. So borrowers who are, you know, who are inactive. So they took the card but they did not use. Like my father does. He has a credit card, he never uses that. So he is in two terms inactive borrower for the bank. Uh, so the bank does not know whether he would be a good or a bad borrower. He's just an inactive borrower. He had taken the card 1 year back and has never done a single transaction. So he is an inactive account. Now the next part that we get to see is that, so how are these three different? So basically, the least risky borrowers for credit cards would be the active borrowers. The active borrowers who are non-delinquent. The relatively more risky group of borrowers would be the delinquent borrowers. So the borrowers who have taken the loan, I mean who use the card but have missed out on a payment. The third group of borrowers that we have over here is the inactive borrowers. So inactive borrowers are the borrowers who are inactive. So I don't know whether they are good or bad because I don't have any performance to decide on it. So they're indeterminate, they're inactive. So based on the borrowers, I can divide them into these three groups. Now, generally, the inactive segment is actually a very small segment in a credit card portfolio. So you will get in some millions, you will get some thousand observations. That's it. Say some hundreds or some thousand observations. Because generally, people who take up credit card, they pay back and they use it. So over there, what we get to see is that borrower, so the active borrowers are relatively less risky than the delinquent borrowers, because borrowers who have already had a history of getting delinquent on the product sometimes or the other have shown that they have gone delinquent once, that is they can miss out payments. Now if that delinquency persists in the future due to some reason, then they would turn out to be defaulters, right? So once they have gone delinquent, they become less trusted for the bank. The bank knows that if they have gone delinquent once or twice in a given time, within a given time period, I know that he can also go delinquent in the future. And if his delinquency can be persistent delinquency for 3 to 4 months continuously, where we might see that he ultimately defaults. On the other hand, what happens over here is that the second person that we are talking about is I mean, he is a non-delinquent borrower. So that means if a borrower, as a borrower, he is active, he has never missed out his payments, and hence this borrower is someone who can be totally relied upon. So he is a less risky borrower. So similarly, over here for personal loans, we can divide at a behavioral stage, basis the delinquency variable, we can divide the total base of population, the total base of the accounts into two parts. One is active borrowers, and the second is uh, one is the set of active borrowers, and the second set of borrowers that we have is the delinquent borrowers. And obviously, yes, the delinquent borrowers are considered to be relatively more risky than the active borrowers. So basis the delinquency, we can assess the overall riskiness of the portfolio. So that's one. Now, apart from being using it as a segmentation variable, different variants of delinquency can be used to capture the riskiness in a personal loans portfolio. So, one such variable is, say, percentage delinquent, or the number of times that the percentage of delinquency events in the last 12 months. Delinquency events in the last 12 months. So in the last 12 months, how what percentage of time has the borrower been delinquent? So it's percentage of delinquency events in last 12 months. Last 12 months. So there is percentage of delinquency events in the last 12 months. So this is defined as the number of times the borrower has been delinquent in the last 12 months. So, say there has been say three events of delinquency in the last 12 months. So, this variable is it takes a value 40% for this borrower, and large higher this percentage value is, it means that more over the last 12 months, this borrower has been delinquent for greater number of times, and hence his chances of missing out on payments have been relatively higher compared to other borrowers, and hence he is considered to be a relatively more risky borrower, right? Hence, having a look into this kind of thing, or having a look into this, we can say that yes, this borrower is a more risky borrower, and higher this value is, the more riskier the borrower will be. Also, now from here, we can actually create out a trend. So I can actually create out a trend and look into the different percentage values, right? But we just hold on a second. Okay. So as I was saying, over here, so, so if I look into this trend, right? So the percentage of time when even in the last 12 months, the delinquencies happened for the borrower, and if I look into this trend, for different segments over a point of time, so then I'll be able to identify how a good borrower or a bad borrower actually works out, right? So that is something that we need to look into. So over here, excuse me. So for borrowers who have a higher value of this kind of, fall into a higher bracket of this percentage of delinquents, they will be obviously considered to be relatively more risky borrowers than others, right? Now, apart from this, there can be other variables, other delinquency variables that we could, or other variants of this delinquency that we can use. Say one variable can be that maximum delinquency, a maximum number of time delinquent, the maximum number of times delinquent in the last 2 months, delinquent at a stretch. So, say for example, I see that the maximum number of times this guy has been delinquent in the last 2 months at a stretch is two or more, right? So then I know that he has been at a if this guy has been delinquent at a stretch for more than 4 months, 4 months or more, then I know that this borrower is again a very risky borrower because this borrower has not been able to, or this borrower has not, like, this borrower again over here has not done, uh, so this borrower has not paid back his EMIs in time, and he has been delinquent for 4 months or more, that is he has been 90 days or more delinquent. Hence, this guy has gone bad. So, if the maximum number of times this guy has been delinquent is two or more, or three or more, then I know that these are the more risky borrowers in the last 12 months. And and using delinquency and other such variables, we can keep on talking, or we can keep on creating different source, we can try and create different, we can capture different elements of riskiness of a given borrower, right? So delinquency variable, from this perspective, variable is one of the most important variable of this behavior model. Now again, another very fundamental variable which shows that the overall riskiness of a borrower is nothing but the month on books. It's called the MOB, or the month on books. So this shows the vintage of the borrower on the books of the bank. So higher the value of this month on books are, I mean higher the value of the borrower month on books is, the better is the borrower, and the less risky is he considered to be. And to understand how good or how bad borrower is, or how does the bad rate differ with a month on books, what we do is something called the seasoning analysis. So in a seasoning analysis, we plot the month on books on one axis and the bad rates on the other. And from there, what we do is we convert them into one part, we convert them in, we look into the trend, that how is it they have been behaving between the values, right? So
Uh,
yeah,
okay. So I have a question. What is this month of on books? Yeah, of books.
month on books is
Yes.
the number of months. Say for example, you opened an account, so you have taken a loan for 5 years, right? So if you have taken a loan for 5 years, it means you have taken a loan actually for 60 months. You have taken a loan for 60 months. Now, if you have taken a loan for 60 months, it means there is an account opening date, and and there is an account closing date. So the difference between your account opening date and your account closing date will be 60 if you very diligently pay back the loan and you do not write off your loan, right? So there would be, so this is the difference between these two will give you the total term of the loan. Now you have opened your account say on the 1st of January 2017, right? So you have been paying your EMIs since then. The past EMI that you pay is on the 15th of Jan. Then what you do is, sorry, first EMI you pay is on the 1st of Feb, second is the 1st of March, 1st of April, like this. So standing as on April 4th, April 1st April 2018, you are 15 months on the books of the bank. So the month on books will be the difference between the account opening date and the as on date. That is the date when we are standing. So as on today, you are 15 months old on the books of the bank, right? So your month on books is 15. The number of months you have been on the account of the bank. Clear?
Yes, clear.
Great. Great. So it is generally seen that as the month on books increases, right, the bad rate of the borrower goes down, the overall bad rate of the portfolio goes down. So for when your account gets seasoned after a point of time, so it reaches a point. So after that, it is seen that the bad rate of the borrower goes down. So an account is said to be seasoned after it has reached a month on books or a value of month on books, after which the bad rate of the portfolio bad rate starts falling down. Say for example over here, I'll just show you. So over here, what we have is over here I'll have the month on books, month on the books of the bank, and over here what I'll have is the bad rate. So it is generally seen that for the lower vintages, the bad rates gradually increase and then they flatten out at a point and then it starts falling. So this is where the account generally tends to season off, right? And this point is called the seasoning. So I know that account which has reached this value of the month on books are seasoned accounts, and from there, if the account has on an average reached this point, the chances of the account to default is very less. This is known as seasoning. And it's generally seen that higher the month on books are, on the whole, lower are the chances of the borrower to default. So this is called the seasoning analysis. The seasonal analysis looks into the explores the riskiness of a borrower along with the vintage of the borrower on the books of the bank. Clear?
Yes,
question?
clear.
Okay, great.
Uh,
Yeah.
no.
Okay. So after this, the next question that we need to think about is that what are the other kind of variables? Obviously, yes, one very important variable that we can consider at the behavior stage of the borrower is to understand the outstanding balance that the guy has to repay as on the date. So what is exactly the amount of the outstanding balance, and you can say the outstanding principal. It can be the outstanding interest, it can be the outstanding amount. So amount which is outstanding as on a given date. So higher this amount is, the lower are the chances of the borrower to not to default. So basically, higher the outstanding balance is, the more exposed will be the bank to the risk of default, right? So this is a very important behavioral variable. Again, as I have said, that the EMIs, the equated monthly installments which are created, that is also a very important factor in assessing the willingness of the borrower to default or not. Now, like this, there can be other similar variables. Like one variable is the amount of balance which has been received. So, relative to the outstanding, how much is the guy paying back? So, how many times has the guy missed out on paying his EMIs? So, after he has missed out, has he paid back both the EMIs together or not? So, these are the different kind of variables which you use to explore personal loans as I mean the behavior is associated with personal loans. Also, the type of the loan, the classification of the loan is another important factor which you use to, you know, which you use for assessing the overall riskiness of the loan. So there are these different kind of variables. So when we start working with the data, we will actually go through the different kind of variables. Okay. So I'll show you a data set tomorrow where we have all the variables listed, where we have all the variables which are there, right? And from there, we'll try to identify which are the variables required for uh, behavior models, which are the variables which are required for application model, and variables which are required for other kind of collection models and so on, right? And then we'll start discussing about the about mortgages as a business product. Now, talking about mortgages and auto loan will be a very different part because they have certain macroeconomic prices associated with them. So, for mortgages, it is the underlying asset price, the housing price, which is again related to macroeconomic factors, and for automobile loans, it is the automobile prices, the price of the cars, which is related, which also is to some extent related to macroeconomic factors. So, the role of macroeconomic factors become very important in both the application as well as in the behavior stages of developing the programs. Right. So that is what we start off with tomorrow.
Okay. Okay, so I just have a concern that when you teach me, I understand all of the strategies that have been going on and everything. But the point is that when I try to connect it in the question answer point of view, or trying to answer some interview questions, then I feel I do not have the correct sequence lined up to me. So, do you have a specific training material that you
Uh,
can provide
so
me?
what you can do is, I think I referred this book to you, right? Nine Cities Intelligence Scorecard.
Yes,
Read that book.
yes,
It's
you
more
did.
than enough.
Okay,
So
okay,
that will be
fine.
your sole reference
And
for scorecard development.
and the recordings, please, so that I can
I'll do
revise
the recordings. I'll do the recordings. I'll share the recordings. I know that.
because I'll start forgetting the older things
No,
now.
no. You start going through the board work. So when once you look into the board works, right? we start
Okay.
connecting to the concept fast. So when you look into this,
Okay. Mm-hmm.
when you look into the scorecards, I mean, when once you look
Okay.
into the board work, that is where you'll be able to connect that, okay, these are the things that has been done. So I'll send the board
Okay.
work to you today or tomorrow because I'm not getting time. I
Okay.
mean, I came back from office yesterday at 2 a.m.
Yes, I understand. Understand.
and you understand how consulting is, right?
Yes,
So
I